I want to welcome everybody to our housing market town hall webinar. We have so much data to share as usual. First of all, if you're on this channel right now, you probably have subscribed to our channel already. If you're not, please do subscribe. We constantly providing you with a lot of data every single month with the most up-to-date information about the market. We are very local, specifically about the Bay Area housing market, but we also want to share with you some of these real estate education. For example, last month we had talked about the pros and cons of Delaware Statutory Trust as an alternative 1031 exchange vehicle. And we had many different topics, so feel free to go onto our YouTube channel and check those out. And of course, if you are on social media, feel free to follow us on Facebook, LinkedIn, and Instagram. All right, last month, we talked about 6 factors that can lead to a recession. There are 2 things that I kind of want to go over again with you guys. We talked about GDP and also rising unemployment. Now, those are the 2 of the factors that typically we would consider them part of the recession, aside from the bankruptcy, defaults, or foreclosures, high interest rates, falling asset prices, and lower consumer spending and consumer confidence. We're going to touch on a little bit on the consumer confidence as well today, but I really want to focus on these 2, number 1 and number 5, about the unemployment and GDP. The reason why is that I just recently watched a video on YouTube by Wall Street Journal, and this is by John Hilsenrath, and he's a Wall Street Journal senior writer. He said that this 2022 recession would be unlike any other. So I was like, okay, I'm curious. I want to watch. I want to see what he means by that. And the first thought was that he's going to say this recession is going to be really bad and it's going to be worse than the previous ones. And then once I started watching it, I thought it was very interesting. And that was kind of like what I've been talking about in our last episodes, why this recession is a little different. And then there are a lot of factors that we cannot really right away saying that, yes, this is going to be really bad or it's going to be okay. So one thing is that we mentioned is the GDP, right? The way we consider there's a recession is that we see there are 2 consecutive quarters of slowing down on the GDP, which we do have right now. So we are kind of consider that this is the beginning of the recession as one of the factors. The other one is that if the GDP comes down, then it can affect a lot of businesses. And one of the 3 things that this video have talked about was that the businesses can lay off workers and also people spend less money. And if people spend less money, then these companies will make less profits. And so this is like a cycle. And then of course, like, again, the business will lay off workers again. So, okay, with these factors, we also do know that with that businesses laying off workers, we've been talking about the unemployment rate being really strong these days. And as a matter of fact, we have this labor force participation rate that they show. Instead of people not able to find work, it's the other way around. The people are not really participating in the job market. And there are way more record high unfilled job rate instead since 2020. It just shot right up during this pandemic. So as a matter of fact, we see everywhere that there is like hiring signs that companies are really trying to hire right now. So in typical recession, for example, around 2001, the red line is the unemployment rate that's going up, right? It should be. And then as the GDP comes down, that should be the normal in the past recessions. However, in today's world, we are seeing the GDP is coming down, but the unemployment rate is also coming down. So I think that's one thing really interesting, and we had talked about it in the past episodes, is that the employment rate is still going strong. We are not seeing that it's going up yet. And then on top of that, we look at the consumer confidence index. Now we have super, super high consumer confidence index in 2020, went up to 41.4. We went from negative 33.4 bounced up to 41.4 as soon as the market kind of opened up. But now we see that it has come down to 1 in June of 2022. But if we look at the chart at the bottom right here, we are seeing that where we are right now is slightly below the 0 line. And then if we look back 25 years, I guess we are still low, but then we are not significantly lower than before, and especially during the last 2 recessions. So this could still continue to come down, don't get me wrong, but it's just that at this moment, the consumer confidence level doesn't seem to be that low yet, although we do see a lot of pessimism in the market. It really depends. I feel like it really depends on how the internet's been sharing the information as well. But we definitely see that the consumer confidence is getting lower. Then in that case, does it mean that this is actually making fewer profits? On the contrary, we actually see corporate have been having really high profit margin and is a record high profit margin. And they also have tons of cash, almost $4 trillion corporate cash on hand. So businesses, according to this YouTube video with the Wall Street Journal, they're saying that because the corporations, they have so much cash on hand and they've been making quite a bit of profit, it potentially could be that they have enough money. They're not going to be laying off the workers because they still have enough money on hand. And so if people have jobs still, they still have employment, then it may not actually really affect the economy, or, like for example, in our industry, real estate industry, is going to be affecting that much. But again, I'm not here to tell everybody that, oh, don't worry about it, our housing market is not going to crash. I just want to share with you these data that I found online, and then also let you think about it. Think about whether this market is really going to crash or not. And definitely would love to hear what you think as well. For the fact that this is another article I read on Silicon Valley Business Journal. There are 3 big multifamily property sales in the Silicon Valley market. Many of you know that I'm also specialized in multifamily. And we always wonder, well, if the interest rate has gone up, that means the cap rate will go up. If the cap rate go up, will there be a lot of sales going on? Will people be willing to sell, or will people still be willing to buy because the rate continue to go up? And funny thing is that end of July, there are 3 investment firms, different investment firms collectively spent nearly $575 million to buy 3 different apartment complexes in the South Bay. Now, the purchases are an indication that investors are bullish on the future of Silicon Valley's economy. That's one thing I thought about, is that we have discussed before that there are a lot of companies, for example, Google, they're building this massive, massive complex. So in order for them to fill these complexes, they will have to continue to hire in the future. Obviously not right now, but in the future. So they gotta have some confidence in this market. And then it looks like these investment firms, they also have some confidence in this market. And they see that this optimism is that many of the region's big tech companies expanded their office space during the pandemic. And that's the indication that they expect to continue to grow and hire. And also many are requiring employees to be in the office at least a few times a week. And such mandates are going to ensure those workers will remain in the area, and many will likely want to live near their offices. We definitely have started to see a number of offices or number of companies are requiring their employees to come back to work at least part-time, 2-3 times a week. So it will make it almost, at least to me, impossible to be living out of state and then come back 2-3 times a week just to work in the area. So we're definitely probably going to start seeing some people either moving over or coming back to the area in the future. Now, with those information, I kind of want to share with you now with the Bay Area housing market stats and see how it compares. Maybe you are looking for a home right now, maybe you're trying to sell, or maybe you're an agent trying to help your clients right now. And so let's take a look at the housing market stats. First of all, we're going to look at the offer battleground. I call it a battleground because it used to be really a battleground. You have to compete with 20, 30 offers, right? But now, again, we now start seeing a lot of single digits. Surprisingly, there are still multiple offers, unlike what the news might have said, that the market is very, very cold. There isn't a lot of buyers on the market, definitely have less. But as you see that, we still see multiple offers right now, especially in the summer. Typically, it has already been slow every summer because families go on vacation. But right now, because of the inflation, because of the interest rate hikes, there are even less people coming out to look. However, they're taking a pause doesn't mean that they're not looking. So if the price is attractive enough, it will get them to come out and look at the properties. And this is what happens, is that we start seeing a lot of people put their very low offer price or asking price and attracted a lot of people to come in and then still have numerous multiple offers. The only difference is that now the multiple offers, people are a lot more conservative when they are making their offers. They're not going above and beyond the asking price. Now, as an example, San Leandro asking price is $599. They sold it at $765. It's still a pretty significant amount, I think, for this particular situation. In Fremont, 1.5 asking and sold it for 1.6 with 3 offers. But then if we look at, let's say, Santa Clara, the original asking price 1.998, and it actually dropped to 1.95. And then now they received 3 offers and still sold it slightly below. That's what we are seeing now. A lot of buyers waiting for the sellers to drop their price before they make an offer. So this is another example. Cupertino, their original offer price was 3.886. They dropped it to 3.595. They got 3 offers in, and then they sold it at 3.752. Et cetera. So you can see the trend over here. It's not crazy over asking price like before, but we are still seeing quite a bit of competition, and we're definitely seeing even more cash offers, because right now, a lot of people, if they have cash, they definitely want to come out and use that as a leverage to negotiate. On top of that, we've been tracking the months of inventory. We've been saying that a normal market, equilibrium market, is around 4 to 6 months of inventory. And we used to be less than 1 month. And that's why you saw that everything comes on the market within the week, we sell it. And it started to climb up since May, June to 1.9, and then July went to 2.1. And it shot up all of a sudden in August to 3.8, close to 4 months now. And in terms of days on the market, we have gone from just a week up to almost 3 weeks. So I would say 2.5 weeks around there. And then you see that people are definitely not as aggressive as before. They're only offering right around the asking price. And we start seeing a lot of people offering maybe slightly below asking price. And if there are some multiple offers or they price it really low just to attract people, people are still not aggressively offering way above asking price. In terms of number of listings withdrawn or canceled, we've been seeing in Santa Clara County, San Mateo County, Alameda County, and Contra Costa County, they all have been going up until June. And then July, actually, they all start coming down a little bit on the withdrawn and canceled. One of the main reasons I could see is that because sellers at the time when they're getting their property ready around this time, when they put it on the market, that's when it started to drop. And at that point, they still wanted to be, to be able to sell it at like the March valuation, but they realized they can't. So they was like, okay, we're going to take it off market and wait until the summer is over. By the time, if they are putting on the market in the summer or July, now some of the sellers, they really, really need to sell. They're not going to take it off market. So this is also another reason why we're continuing to encourage buyers in the summer. Right now, August, you still have some time. If you do see a property, please do negotiate with the sellers, because if the sellers are on the market right now, typically they are really motivated and they really want to sell. How many listing price have been decreased? I was a little bit shocked. I know it's going to go up, continue to go up, but as you see, Santa Clara County, Alameda County, well, actually really San Mateo County as well, and Contra Costa County in the month of July just jumped up significantly. I'm talking about almost 3 folds in July for Santa Clara County. That's how many listings they have to drop their prices. I've heard so many people, some of the sellers and sometimes my friends of some sellers would tell me that they feel very discouraged. But I just want to, again, emphasize that this is the market, unfortunately, that we are in. It is really not your property per se, but a lot of sellers are on the same boat and they all have to drop their prices during this time. And it's almost like a strategy now, because we mentioned earlier, a lot of buyers, they wait for the list price to drop before they even make a move. So work with your realtors, make sure that you are pricing your property the right way so that you can attract an offer. But don't worry, the sellers of the top 10 states that have most dropping prices is not here yet. We see that in Boise, Idaho, 61% of the sellers are dropping asking prices. Denver, Colorado, Salt Lake City, Tacoma, Grand Rapids, Sacramento. Did you notice these are all the areas that used to be the hottest market in the country, everybody wants to move to, and now they're also dropping prices as well. So it is definitely happening all over the country. And in terms of transactions fell through, I feel like the numbers, even though it is increasing, is not as much as I thought. Because one of the things is that some people think, well, if the market is changing, some buyers may have gone under contract and then they regret it. It's like, oh my God, the market is dropping, so I better pull out. I would much rather to lose my earnest money deposit than going in. Although we are definitely seeing more, but considering 4 counties combined, we're only seeing less than 200 deals that have transactions fell through. Is not as bad as I thought it would have been, considering like how much internet news about how bad this housing market is going to go. Now, in terms of the median sales price, it is definitely coming down for these single family homes prices. In Santa Clara County, we had gone down to $1.65 million from the highest at 1.95. And then San Mateo County, it went from the highs at 2.25 in April, came down to $1.8 million. And Alameda County went from 1.5 in May, now came down to 1.225. And Contra Costa went from the highs at 980, now came down to 860,000. They kind of came down about 20% from the peak in 2020. But if we're looking in terms of like from last month, we came down about 4% for Santa Clara County, but actually it's still positive from last year of August. And then San Mateo County, it didn't change from July, but from last year, it came down to 2.7%. Alameda County came down 4.67% from last year, and Contra Costa County came down 1% from last year. So the biggest question is the housing market going to crash or not over here, right? And there's this big debate between I guess they're not really debating. It was just Dave Ramsey, who's very vocal about that. He doesn't think there's going to be a housing market crash. One party think that there's going to be a surge of inventory coming onto the market because all the sellers who did not want to sell yet, thinking that the market is going to continue to go up, and then now they're going to start coming back out to sell their property. And Dave Ramsey is saying that, look, our current supply is just not high enough. Compared to 2007, we have 3.7 million properties on the market. Right now, we are only 1/4 of what we used to have. So there's no way we can even catch up to 2007 level. So there are these two debates. So that's why I'm kind of curious. I just wanted to look at the supply in our counties versus our demand. If we look at the supply, definitely have gone up. If we just look at the past 12 months, is at 9,774 listings. This is active listings. And if we're looking at the differences between the supply and sold, we see that mostly there are about 2,000 something listings differences. And including this one is probably one of the largest differentiation, would be about 2,000 something listings differences. Now, we have this one in 2021, we actually have a little bit more sales than the active listings coming on the market. But if we look at July, this differentiation, we have about 5,727 is probably one of the largest. What I'm trying to show here is that we do have higher supply compared to the last 12 months, and we do have a quite low of a demand compared to the last 12 months. But if we go back 3 years and look at 3 years number, then we see that our supply here is actually not the highest. We are kind of still lower than 2020 level, and also definitely lower than 2019 level. Demand in terms of like how much sales we had, it is one of the lower ones. We are lower than 2019, because I mentioned 2019 is because we also had a slowdown in the market at the time. The property stayed on the market a little bit longer as well. By looking at that differences between the active listings and the number of sold, we can see that this is actually not as much as the 2019 level yet. So the demand is not as high as before, but then the supply is definitely not as high as in 2019. And then the difference is actually smaller than 2019. What can affect the demand on the market? So we're going to look at one of the biggest factors right now is because of the interest rate. As always, we track Freddie Mac, Fannie Mae, Mortgage Bankers Association, National Association of Realtors, their projections, and they have been increasing their projections on their mortgage rates. We definitely see that they are going up, but it seems like the 4Q, they're all topping at 4Q. And then for Freddie Mac, Fannie Mae, and Mortgage Bankers Association, expecting they're starting to stable and slowing down, or maybe come down slightly 2Q of 2023 and 3Q 2023. So that can absolutely affect your demand. Also, CNBC had a segment, and then they looked at the consumer housing intentions by UBS Lab survey, and 36% of people that they surveyed plan to purchase a residential property in the next 12 months. We mentioned again a lot before is that a lot of people are taking a pause to buy. They're not stopping buying properties. They just plan to purchase it later in the next 12 months. They're observing right now. And then there are 27% plan to sell their home in the next 12 months. And 66% believe that finding an affordable home will be somewhat to very easy in the next 12 months. Definitely, we're going to see some increase in the demand to purchase property again. And I think that the price will drop to a level where people are going to just come back out and say, you know what, even with a higher interest rate, I think it is time to come back out to look, because at the end of the day, we want to know whether the supply is really satisfying the demand that we have. Now, speaking of supply, of course, we really need to rely on the construction in order to satisfy the supply. And we've been talking so much about the shortage of housing in the country, and especially in California. In California, we're short about 2 million units. Is that number about right?
I think it's a bit exaggerated, but there clearly is demand in California for housing.
So how many units do you think that is really short by?
I think it's over. I think we overestimate the number of units that are in demand based on not only population growth, but household formation. And we're seeing an exodus of people right now, and I have a slide that shows that in the Bay Area. But as a state as a whole, more people are leaving than are coming. So the population is actually declining. Um, and part of that is that housing is just so unaffordable. It takes a long time to get housing built, and certainly certainly higher interest rates aren't helping that at all right now. So um, I think that number tends to be exaggerated. I also think that the aging of the population, there's quite a significant baby boom population in the state of California, and those folks are going to be making decisions. Not only will they just be dying because they're getting older, but they may be moving into other facilities, whether it's active adults or assisted living type memory care things, and there's going to be a transfer of those units to younger folks. So that may alleviate some of that demand for newer construction than we would project. I just think that the governor had come out, I don't know, 2 years ago. Haven't heard much about it lately, but he came out earlier and said that we need, I forget the exact number, X number of millions of houses built per year, and I think that number was exaggerated.
So exaggerated, we would say about half of it would be more likely the number.
I think so. But yeah, I mean, it's probably reasonable. Again, I don't recall the number off the top of my head, but we're just not seeing population growth as significant as it was 20 years ago,
That's
30 years ago.
That's good to hear, in the sense that we at least not as bad as we thought, but at the same time, I'm really curious to hear about whether the construction is really continue to increase or not. And then like this chart or this graph has shown from by CNBC is saying that actually housing completion, we've done better than last year. We had increased 9.3% of the housing construction. So that's great news, because we definitely need more supply. Jerry Howard is the CEO of National Association of Home Builders. He does feel that the market is definitely suffering. He says US home builder sentiment falls. So I think this is a good segue to come to you now and then ask you what you think, because obviously you give a lot of these home builders your advice and your data as well. I hope that our audience got a lot of great information. The most important thing is that we are sharing statistics with you just so that you can make the right decision for your own investments, or if you're an agent, use those information to advise your clients. So, well, hopefully I can see you guys next month, and don't forget to subscribe.